Hello, Friday. Right, we're going to start with the Core Logic House Price Index in the United States. Now, I know I did the Case-Shiller only a couple of days ago, but this one is A, slightly clearer, and B, it's the one that the Fed uses to base any judgments it might want to be making on this one, on the Core Logic. And as you can see, it's in a bit of a horrid state. And human brain, extrapolation, looking very downwardsy. And I think the Fed will act on this. Given half a chance, it will QE3 and throw in more MBS buying. I know it's got a shed load already, but I think it'll take another delivery. Because that doesn't look too healthy, does it? It looks very pointy, certainly not pointy upwardsy. Yeah, okay. Right, now this is going to be a theme. Not much of a theme, but a theme. And it's a macro, big theme. So open your minds to big theme stuff. The bad news is that, okay, what is this? I should really tell you what this is. It's on Scott Sumner's blog, but I'm not actually sure that he wrote this. And he's talking about Matt Iglesias. What we're talking about is big dick economists in the United States. And Scott Sumner, I think, is Chicago school. And it doesn't matter what people are. I can't, it's what they say is important. Anyway, what he said here, and I think, let's say it's Scott Sumner, is quite important to at least give us our theme. The bad news is that, in some respects, I think it's even worse than Iglesias suggests. This is the first recession in my entire life where nominal interest rates fell to near zero. And yet, I wouldn't be at all surprised if this occurred in every single future recession during my lifetime. That is a big idea. In my view, Scott Sumner, Japan is the future of the global economy. This is big shit, man. Not the deflation. Brackets, I think the Fed will be able to keep inflation close to 2%. Close brackets. But the low real interest rates. In retrospect, the 2001 recession, when rates fell to 1%, was the canary in the coal mine. Nominal rates will probably be unusually low from this point forward. Another big thing coming up. Global saving will increase dramatically as the Asian countries get richer. Remember that most people are Asians. And slowing population growth outside of Africa will dramatically reduce the demand for investment funds. Okay, what we have is in the West the boomer funds, in investments, pension funds, monstrous huge amount of money that is actually out there. He says the Asians are going to be piling in. There's going to be a monstrous great savings amount of money, but not much demand. Where the bloody hell can they put the stuff is what it's all about. And rates really are going to be driven low anyway by this sale and demand, a mass of money going into bonds, keeping bond rates low effectively forever. But if any of these Western economies, which is starting to be doubtful, ever does get off the zero bound or very low interest rates, then what would probably happen a la Japan, it would instantly cause a recession and the interest rates would go straight back down again. So there is going to be this monstrous amount of cash out there getting just about no return at all. Okay, moving on to Bill Gross, who has been writing the most amazingly mind-boggling stuff lately. But this hopefully makes sense from one of his last PIMCO letters. Modern capitalism is dependent as well on maturity extension in credit markets. Modern capitalism is dependent as well on maturity extension in credit markets. Let's go on a bit. Hey? No venture, aside from one financed with 100% owner's capital, could survive on credit or loans that matured or were callable overnight. What he's saying is that business does not survive on overnight, rolling overnight borrowing. Banks do. Some insurance companies do. Other places do. But, your factory can't do that because it'd be suicide. What a factory needs is a 20-year loan, a 30-year loan. Yep, okay. So that's what that first bit's about. Okay. Buildings, utilities and homes, here we go, require 20 and 30-year loan commitments to smooth and justify their returns. Because this is so, lenders require a yield premium, expressed as a positively sloped yield curve. Now, that's bottom left, top right yield curve. Let's say the curve is just a straight line, and the yield curve is because it is generally curved, convex or concave. But we can imagine the yield curve as a straight line, bottom left, top right. Down in the bottom left is the very short-term bills, 3 months, and you'll get just about no interest on those at all. And you wouldn't expect to, because you're just really paying somebody money to keep the money safe for you. But if you project it out 5 years, you expect a bit more. 10 years, you expect a bit more. 30 years, you expect a bit more for inflation risk, default risk, and I can't use my money. I want paying recompense for that. So the shorter term bottom left, going out to the top right, is the yield curve, and it should be. If it's going to be steep, it means it'll be pegged down at the bottom left always, but it means that you across that curve or up that straight line, you're getting more and more and more interest as you are willing to lend somebody over a longer and longer period. Yeah? Yeah. So lenders require a yield premium expressed as a positively sloped yield curve to make the extended loan. If it's really flat like this, well, where are you going to pick on that yield curve, that yield straight line? Would you want to lend at 30 years when you're only going to get this little amount of interest? No. So you pull back on the yield curve. Would I want to lend for 10 years to get... No. And this is what we're going to get here. A flat yield curve, in contrast, is a disincentive for lenders to lend unless there is sufficient downside room for yields to fall and provide bond market capital gains. All right. Over the last 30 years, exceptionally fortunately for Mr. Gross, there has been a bull market in bonds, treasury bonds, but bonds in general. Bottom left, top right, the interest rates have been coming down. That it's like the whole yield curve has just been undermined from the bottom for 30 years. They've been digging away at the bottom, and the whole thing, bottom left, top right, has just been going down and down and down. Now, what this means is you buy a bond at 100 and it gives you a yield of 3%, wherever on that yield curve it might be. Now, you're not going to get any more than the 3% because that's what the contract's for. But with it being undermined, and the whole line, the slope dropping downwards, it means that after you bought that bond for 100 for the 3-year yield, later somebody is going to be willing to pay you 110 for that 3-year yield. So although your yield doesn't change, somebody will be willing to give you more money for that piece of paper you're holding, because time has moved on and yields are only available at now 2.7, 2.8. So to get the 3% yield, somebody will give you 110 for that bond. They will have calculated on a little spreadsheet that it's worth doing so. And this is what Bill Gross is saying here. It's worth getting a small amount of interest, even if the yield curve is quite flat. You're only getting a small number. If in the future you think the whole thing is going to move downwards and somebody will offer you more money for your bond, you won't never get more interest, but somebody might offer you more money for your bond, and that would be your capital gain because you've sold your bond. So a flat yield curve, in contrast, is disincentive for lenders to lend unless there is sufficient downside room, that's what I was talking about there, for yields to fall, price to go up, and provide bond market capital gains. You make money. The yield goes down, the price goes up, and you say, I'll accept that price and make a capital gain. This nominal or even real interest rate margin is why prior cyclical periods of curve flatness or even inversion have been successfully followed by economic expansions. Intermediate and long rates, even though flat and equal to short-term policy rate, have had room to fall. There was always that idea, well, at least I can make a capital gain, even if I'm only going to get a small amount of interest. And credit, therefore, has not been trapped by price. And that's what that means. When all yields approach the zero bound, and we're really getting down here now, as in Japan for the last 10 years, and now in the United States, and selected clean, dirty shirt sovereigns, means all the sovereigns are dirty, but one's a bit cleaner than the rest, then the dynamics may change. Money can become less liquid and frozen by price, in addition to the classic liquidity trap explained by risk. So we've got our risk premium, inflation premium, and there's no chance of an upside because things are so flat. You're never going to get your capital gain because nobody's going to offer you 110 when you bought at 100. They might, with the fluctuations of things and scares in the market, you might get to 102, 103, but you're really no upside on that bond at all. And that's what Gross is saying. And it's getting to be a real, what's the bloody point of owning these bonds? And he'd obviously worked this out last year and thought the bond market was going to turn last year against bonds, and actually made a huge loss for his company because he thought it had happened earlier than it did. He hasn't worked out what the other chap has worked out. There is a monstrous quantity of money that has got absolutely nowhere to go. And this is another point. These insurance companies, pension companies, want safety for their money. The Fed's coming along and saying, well, for the next 3 or 4 years, things are going to be totally crap. I know this because I'm going to guarantee zero interest rates. So what the pension companies are doing is saying, well, okay, the best I can hope for then is a return of the money that I invest, not a return on the money I invest. And they're happy just to get out alive. So even in 3 or 4 years' time, if they can come out with the amount of money that they've got now, they'll be happy. Arse covered. They're happy. And that's what Gross is talking about. Everything goes, and that's what we've got. Right. I would have liked to have stopped there, but just to kind of, that contracts everything, and then we know whatever really contracts has got to explode. We've got to imagine what an explosion might be. But always you've got to remember the huge weight of those boomer savings and the new Asian savings stacking on top of them. That's a huge weight pressing down. Okay? But what might pop up and blow through? And this is from Japan. Update. Megabank braces for government bond crash. The nation's largest bank has drawn up a contingency plan to deal with a hypothetical plunge in Japanese government bond prices. Prices down, interest rates up. The Bank of Tokyo Mitsubishi said it is possible, prices could fall markedly rates go up markedly, pushing up the key long-term interest rate. That's at the long term, at the end of the yield curve, up from about 1% at the end, at the long end. I mean, it's like this. Up to 3.5 towards 2016. That is an explosion. It's ridiculous that the long-term bond would be up to 3.5, and that would be an explosion. But that's what we're talking here, because they're so used now. Everything's predicated on it being low. The bank owns $4.2 trillion yen. But it's still $500 billion worth of government bonds, and that's the second largest holding after the Japan Post Bank. The people generally use Japan Post Bank. But said it would sell government bonds with a maturity of 10 years or longer, worth up to 3 trillion yen in the event of a spike in the yield on the benchmark 10-year government bond. What this is Mitsubishi, the biggest bank, saying they've all done it. They've all done these contingency plans for years now, and nothing's happened. But this is just one more. We are edging towards the exits. It might explode. People have bet and lost huge fortunes over the last almost a decade betting that Japan will blow. But it's always this great bulking load of savings that stops it from blowing. But it's one hell of a pressure cooker out there. That's the end. Bye.